Today's financial markets can be summed up in 3 words: global, fast, and complex. But as the market structure evolves, so must the regulatory structure that oversees it. John Lothian News has spoken with several industry experts and put together this series on the evolution of financial market structure. In Part 2, Peter Nabicht, Senior Advisor of the Modern Markets Initiative, looks at the nature of liquidity and how high-speed traders have aided liquidity over the last decade.
There is some concern that change could lower liquidity in the market and make it more difficult for investors to get fair prices and keep their low cost of investment that they currently have. Now, there's a lot of confusion around liquidity. I've heard a lot in the media and in interviews over the last 2 weeks that, don't count that liquidity discussion because liquidity and volume aren't the same thing. 100% agree. Liquidity and volume are not the same thing. Liquidity has a very, I think in my mind, basic definition. Liquidity is supply meeting investors' demand to get in and out of position at an effective price and in a timely manner and with enough supply to meet the demand. That's 3 components, right? Just supply for the demand of getting in and out of positions, timely execution, and a good price. Now, high-frequency trading has aided all of that. Professional traders using high-frequency trading have tightened the markets. They've provided more size. This isn't just me speaking. This is numbers you can look at and actually see that there are benefits. So Harris has a paper out, Equity Trading in the 21st Century. And what that did is took the last 10 years of data from 2003 to 2013, when high-frequency trading really started to come into the markets and provide a lot of liquidity. And it looked at what the benefits were to that. And what it saw was that the displayed size, the displayed depth of markets on both sides of the market has increased 3 times. So it's been multiplied by 3. So now we've got more supply to meet the demand of investors. They saw that execution speeds have been vastly lowered. So it's now faster than ever for investors to get their fills. Okay, so now we've met it in a timely manner, in a more timely manner. And the third component of that is a better price. And what they found is the bid-ask spread across most equities has been cut in half. So now that's a better price for the end investor. So what we see is over the last 10 years, we actually can see the fundamental benefits of electronic trading in the markets. One of the fundamental misunderstandings, and I think this misunderstanding is also propagated in the book, Flash Boys, is that high-frequency traders or high-frequency trading by professional traders is competing with end investors. It's really not the case at all. In fact, high-frequency traders tend to compete with each other to get market share. And when they're doing that, they are investing in technology, and they're investing in risk management, and they're investing in pricing strategies in order to make better prices. I think the odds of regulators improving the market with changes to market structure over the next couple of years are good, but it depends on how regulators go about making the changes. The more we simplify the market structure, the less fragile the market structure will be, the easier it will be to understand, which allows for people to have more confidence in it. People are more confident in that which they can understand.